Good morning and welcome to The Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Wednesday, July 22nd, 2026, and we've got a packed show. Alphabet and Tesla report Q2 tonight as the first Magnificent Seven names to step up to the plate. Oil is pushing above $90 on US-Iran Iran tensions, and the semiconductor sector is whipsawing traders across the board. Let's get straight into it. Lizzie, futures are sliding this morning with Nasdaq 100 down close to 1%, oil pushing above $90 on US-Iran strikes, and inflation fears are back. How is the market positioning itself ahead of tonight's Alphabet and Tesla prints?
Morning, Robert. The market is in a genuine holding pattern right now. You've got Nasdaq 100 futures down around 0.7 to 0.9% as Brent crude surges above $90. And that's reigniting the inflation narrative that traders thought they'd largely put to bed. The dynamic here is that tonight's prints from Alphabet and Tesla aren't just earnings reports. They're effectively a referendum on whether the AI investment thesis can survive a macro backdrop of rising oil, elevated yields, and a semiconductor sector that has erased roughly $3.3 trillion in chip stock value globally. Traders are reducing risk into the print, and you can see that in the sentiment data where SPY has flipped to extremely bearish and QQQ has moved to neutral. So positioning is clearly defensive heading into the close.
The semiconductor story has been whipsawing traders all week. We saw $3.3 trillion erased from chip stocks globally, but then Tuesday the Philadelphia Semi Index surged over 5%. Is this a genuine recovery or just a relief bounce inside a deeper unwind?
Honestly, it looks more like a relief bounce than a genuine structural recovery at this point. The volatility gap between chip stocks and the wider market has reached nearly 47 points, which is actually wider than the fear spread we saw during the Liberation Day tariff panic back in April 2025. And what makes this different is that the fear is sector-specific rather than broad-based. The key technical level the market is watching is whether the stocks can hold above 12,000. And as long as roughly two-thirds of S&P 500 stocks remain above their 200-day moving averages and the advanced decline line holds near its record high, this reads more like rotation pressure than a full AI unwind. But that picture changes quickly if tonight's earnings disappoint on capex guidance.
Micron was up over 12% Tuesday, SanDisk up 14%, and Bank of America reiterated buy on Micron with a $1,550 price target, calling it a summer reset. Do you buy that thesis?
The buffet framing is reasonable, but it requires a specific set of conditions to hold. The summer reset narrative works if tonight's hyperscaler capex commentary from Alphabet confirms that AI infrastructure spending remains intact, because Micron's recovery is essentially a derivative bet on continued data center build-out rather than a standalone fundamental call. The super micro data point is quite supportive here. SMCI surged 16% in pre-market after reporting a record $60 billion quarterly AI infrastructure order backlog with projected margin expansion. And that kind of order flow is a meaningful leading indicator that the demand side of the chip equation hasn't collapsed, even if the stocks have been punished. At a 1,550 target against current levels, BOFA is implying roughly 60% upside. So the risk-reward is notable if tonight's earnings deliver the capex confirmation the market needs.
Tonight is the real test. Alphabet and Tesla are first out of the Magnificent Seven gate. What are the specific signals investors need to see from each to keep the AI narrative intact?
For Alphabet, the two numbers that matter most are Google Cloud revenue growth. The market needs to see acceleration, or at minimum stable growth, to confirm that enterprise AI adoption is translating into real monetization, and capital expenditure guidance for the back half of 2026, because any reduction there would send shockwaves through the entire AI supply chain from NVIDIA down to the memory names. The YouTube engagement story is genuinely supportive heading into this print. Over 1.7 billion unique global viewers watched the FIFA World Cup on the platform. Morningstar recently assigned YouTube a wide economic moat, and the advertising ecosystem argument is solid. The question is whether that translates into revenue numbers that match elevated street expectations. For Tesla, investors want to see robotaxi progress with concrete timelines and capital expenditure discipline, rather than a blank check into a vision that's still years from generating real returns. CQs.
IBM flagged a pre-earnings warning last week that triggered a sharp stock drop. It reports tonight, too. Is that a company-specific red flag or a warning shot for enterprise tech demand more broadly?
The IBM warning is probably more company-specific than systemic, but it absolutely adds to the anxiety around tonight's reporting window. IBM is navigating a complicated transition away from legacy services toward hybrid cloud and AI consulting, And execution risk there is structurally higher than at pure-play hyperscalers. The concern for the broader enterprise tech trade is that if IBM's weakness reflects slower corporate IT spending decisions rather than IBM-specific execution failures, that could complicate the narrative for names like Danaher, which already fell nearly 11% on weak revenue guidance this week. Watch how management frames the demand environment on the call tonight. That commentary will matter more than the headline number.
Steve, tomorrow we get initial jobless claims. The forecast is 212,000 versus last week's actual of 208,000 mouse, which itself came in well below the prior forecast of 217,000. What does a continued run of tight claims numbers tell us about where the labor market really stands?
The recent trajectory in jobless claims is telling a fairly clear story about underlying labor market resilience. Last week's 208,000 actual print came in 9,000 below the consensus forecast of 217,000, and the prior week had stood at 216,000. So we're looking at a consistent pattern of initial filings holding well below what most forecasters expected heading into the second half of the year. Tomorrow's print is forecast at 212,000, which would represent a modest uptick from last week, but would still sit at levels historically associated with a tight labor market rather than any meaningful deterioration in employment conditions. What this sustained tightness in claims tells us is that while the broader economy is absorbing considerable macro pressure, rising oil, tariff escalation, geopolitical uncertainty, firms are not yet moving to cut headcount in any significant way, and that limits the Federal Reserve's flexibility to ease policy even as other indicators create cross-currents.
Markets are pricing in a 50 to 60% probability of a Fed rate hike in September, with the 10-year Treasury near 4.6%. Does the macro data support that pricing, or does it look mispriced to you?
Given everything on the data dashboard right now, that September hike probability looks reasonably grounded rather than speculative. The oil spike from the Iran conflict is a significant variable here because energy prices feed directly into headline inflation with a lag of roughly 6 to 8 weeks, meaning the September FOMC meeting falls right in the window where elevated crude could be showing up in CPI prints. The 10-year Treasury sitting near 4.6% is already embedding some of that concern, and with the labor market remaining tight as the claims data confirms, the Fed has limited justification to look through an energy-driven inflation impulse the way it might in a weakening jobs environment. On the tariff side, the proposed 100% duty on imported generic drugs and the new 25% tariff on Brazil represent additional upside inflation risk that the market is only beginning to price. Manufacturing profits hit $773 billion in Q1, up nearly 13% year over year, but that durability looks increasingly questionable as input cost pressures from both energy and tariffs compound through the second half of the year.
Lizzie, over to crypto. The Clarity Act is acting like a binary switch for the whole sector. Coinbase surged 11% when Treasury Secretary Bessent said it was on the Senate's 1 yard line. Then a Politico report questioning Democratic support triggered $400 million in liquidations. How are traders actually playing this regulatory uncertainty?
The volatility pattern around the Clarity Act is itself the trade right now. What you're seeing is a market that has essentially assigned binary, option-like characteristics to this legislation, where any credible signal of passage triggers immediate broad-based buying across Coinbase, Circle, Strategy, and the major coins. And any doubt flips it just as fast. Bitcoin crossed $66,000 on the Bessent headline, before pulling back below $63,000 when the Politico report hit. And that $3,000 swing on a single news item tells you that positioning is speculative rather than conviction-based at this stage. Bitcoin is currently sitting near $65,981, and the broader picture remains constructive but fragile pending that Senate vote.
XRP and Ethereum are outperforming Bitcoin on both daily and weekly timeframes, and analysts are calling this the start of an altcoin breakout. What are the key levels to watch across ETH and SOL?
There are genuine structural drivers behind the ETH and XRP outperformance that make this more than just noise. ETHI and XRP each gained over 3.7% on a daily basis versus BTC's 3.1%, and on a weekly basis, both also outpaced Bitcoin's 5.6% gain. For Ethereum specifically, the combination of institutional accumulation, Tom Lee calling it a bottoming process with a $2,200 price target from technical analyst Tom DeMark for August, and now Grayscale formalizing quarterly staking payouts on its Ethereum and Solana ETFs starting around August 7th, creates a meaningful demand layer. That staking clarity is significant for institutions that have been waiting on yield confirmation before allocating, because it removes the ambiguity around how rewards are treated within a grant or trust structure. Solana is sitting at 77.60 cents, and analysts have specifically flagged it as a top pick for this cycle, while the critical level for Bitcoin remains $69,000, reclaiming that as support would be the signal that this is a genuine bull trend rather than just a recovery bounce.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.